Something absolutely unprecedented just happened. And if you carry credit card debt, if you've ever been crushed by a 25% or 30% interest rate on a balance you can't quite pay off, what I'm about to show you could save you thousands of dollars. Or it could get killed in Washington before it even gets started. On Friday night, January 10th, 2026, President Donald Trump posted on Truth Social a message that sent shockwaves through Wall Street and caused immediate panic among America's biggest banks. According to reports from the Washington Post, CBS News, and CNN, Trump announced that he is calling for a one-year cap on credit card interest rates at 10%, and he wants it effective January 20th, 2026, exactly 1 year after his second inauguration. Now, before you dismiss this as political theater or campaign rhetoric, let me show you the numbers, because the numbers tell you why banks are absolutely terrified right now, and why this proposal, if it actually happens, would represent the single largest transfer of wealth from Wall Street to Main Street in modern American history. According to the Federal Reserve, credit card interest rates currently average over 21%. Some cards charge 25%. Some charge 30%. If you're carrying a balance, you know exactly what I'm talking about. You make your monthly payment, and it feels like the balance barely moves because half of what you're paying is just interest. How much money are we talking about? According to the Federal Reserve Bank of New York, Americans owed a total of $1.23 trillion in credit card debt in the third quarter of last year. That is the highest level on record, ever. A 2024 study by NerdWallet found that the average U.S. household with credit card debt owed $10,163. Think about that. Over $10,000 per household, accruing interest at 21% or higher. And according to the Consumer Financial Protection Bureau, Americans were charged $160 billion in credit card interest in 2024 alone. $160 billion. That's more than the entire GDP of countries like Hungary or New Zealand. That money came out of American households and went straight into bank profits. Now, here's where it gets interesting. According to research from the Vanderbilt Policy Accelerator, if Trump's proposed 10% cap were implemented, it would save Americans $100 billion per year. Let me repeat that. $100 billion per year back in the pockets of American families instead of bank shareholders. That's why banks are panicking. That's why the American Bankers Association, the Bank Policy Institute, the Consumer Bankers Association, and every major banking lobby group issued a joint statement within hours of Trump's announcement, saying this would be, quote, devastating and would reduce credit availability. But let's be very clear about what we're actually discussing here. This is not some radical socialist proposal from the far left. This is a sitting Republican president, backed by both Republican Senator Josh Hawley of Missouri and Independent Senator Bernie Sanders of Vermont, who have already introduced bipartisan legislation proposing this exact same 10% cap. In fact, Representatives Alexandria Ocasio-Cortez, a Democrat from New York, and Anna Paulina Luna, a Republican from Florida and Trump ally, have also proposed similar legislation. This has support across the political spectrum because voters across the political spectrum are getting crushed by credit card debt. So why now? Why is Trump pushing this? According to multiple reports, Republican lawmakers have been urging the president to address the high cost of living for Americans, as it remains a top concern for voters, especially going into the midterm elections later this year. Senator Lisa Murkowski, a Republican from Alaska, was quoted last month saying to Trump regarding affordability concerns, quote, "You can't call it a hoax and suggest that people are going to believe it. What you say matters." Trump knows that if Republicans want to keep control of Congress, they need to show tangible results on pocketbook issues. And credit card interest is one of the most direct, most visible costs that millions of Americans deal with every single month. But here's the critical question. Can he actually do this? Trump's announcement was vague on implementation. He didn't specify whether this would be done through executive action, through legislation, or through voluntary pressure on credit card companies. Senator Elizabeth Warren, a Democrat on the Senate Banking Committee, called Trump's post meaningless without a bill being passed by Congress. She said, quote, "Begging credit card companies to play nice is a joke." And she has a point. The president doesn't have unilateral authority to cap interest rates. That would require either legislation from Congress or possibly regulatory action through financial agencies. But Trump's administration has actually been gutting those agencies. According to multiple reports, the Consumer Financial Protection Bureau, which is largely tasked with going after credit card companies for alleged wrongdoing, has been largely non-functional since Trump took office. Trump's administration also asked a federal court to throw out a Biden-era regulation that would have capped credit card late fees at $8, which would have saved families more than $10 billion a year, according to CFPB estimates. So there's a contradiction here. Trump is calling for lower rates while simultaneously removing the regulatory infrastructure that could enforce lower rates. This is why some analysts are skeptical about whether this is a genuine policy push or political posturing. But let's assume for a moment that this is real. Let's assume legislation actually gets introduced and gains momentum. What would happen? First, let's look at the bank's argument against this. The banking industry claims that a 10% cap would force them to cut off credit access to millions of Americans, especially those with lower credit scores. According to the Bank Policy Institute, more than 14 million American households that rarely pay their credit card balances in full could have their access to credit eliminated or curtailed by a 10% cap. They argue that credit cards are unsecured debt, meaning there's no collateral. If someone defaults, the bank loses that money. Therefore, they need to charge higher interest rates to higher-risk borrowers to offset those losses. If they can't charge 25% or 30% to risky customers, they simply won't lend to those customers at all. There is some historical evidence to support this concern. Arkansas has a strictly enforced interest rate cap of 17%, and evidence points to people with poor credit being cut out of consumer credit markets in that state. Research from Vanderbilt showed that a 10% cap would likely result in banks lending less to those with credit scores below 600. But here's the counter-argument, and it's a strong one. According to Brian Shearer, Director of Competition and Regulatory Policy at the Vanderbilt Policy Accelerator, quote, a 10% credit card interest cap would save Americans $100 billion a year without causing massive account closures, as banks claim. That's because the few large banks that dominate the credit card market are making absolutely massive profits on customers at all income levels. Let me show you what he means by massive profits. According to Senator Bernie Sanders, JP Morgan CEO Jamie Dimon made $70 million in compensation last year. Not the entire JP Morgan company. One man. $770 million. Now, Jamie Dimon is obviously an extreme example, but the broader point is valid. The credit card industry is extraordinarily profitable. The Consumer Financial Protection Bureau found in 2023 that credit card rates have soared, quote, far above the cost of offering credit. In other words, banks aren't charging 21% because that's what it costs them to lend money. They're charging 21% because they can, because the market is dominated by a handful of giant banks, and consumers don't have better options. In fact, Capital One just finalized its purchase and merger with Discover Financial in early 2025, a deal that created the nation's largest credit card company. This merger got little resistance from the Trump administration. So we're seeing consolidation, which reduces competition, which allows banks to charge higher rates. The average 30-year fixed mortgage rate right now is just above 6%, according to Freddie Mac data. Mortgages are secured by property, so there's collateral. But still, think about the spread. A secured loan, 6%. An unsecured credit card loan, 21%. That's a 15 percentage point difference. Is that entirely justified by risk, or is some of that pure profit extraction? Let's put this in personal terms. If you're carrying $10,000 in credit card debt at 21% interest, and you pay it off over 3 years, you'll pay more than $3,500 in interest. That's on top of the $10,000 principal. If the rate were capped at 10%, you'd pay about $1,600 in interest over the same period. That's a savings of nearly $2,000 for one household on one balance. Multiply that across millions of households, and you get to that $100 billion figure. Now, here's where this gets politically fascinating. Trump campaigned on this issue. According to reports, he proposed capping credit card interest rates at 10% on the campaign trail back in September 2024. But once he took office, he sided with banks on other issues, like killing the $8 late fee cap. Bernie Sanders called him out on this hours before Trump's Friday night post. Sanders said on X, quote, Trump promised to cap credit card interest rates at 10% and stop Wall Street from getting away with murder. Instead, he deregulated big banks, charging up to 30% interest on credit cards. The result? Last year, JP Morgan CEO Jamie Dimon made $770 million. Unacceptable. Then, just hours later, Trump made his announcement. Was this Trump responding to Bernie's criticism? Was it Trump trying to outflank Democrats on a populist economic issue? Was it genuine policy conviction? Or was it political theater designed to win points with voters while knowing it won't actually pass? We don't know. But what we do know is that this proposal has put enormous pressure on Republicans in Congress. Senator Roger Marshall, a Republican from Kansas, said he talked with Trump on Friday night and that the effort is meant to, quote, lower costs for American families and to rein in greedy credit card companies who have been ripping off hardworking Americans. Marshall said he would work on legislation with Trump's, quote, full support, so there may actually be a bill coming. But here's the political problem for Republicans. The banking industry is one of the most powerful lobbying forces in Washington. Banks donate to campaigns. They employ armies of lobbyists. They can make life very difficult for lawmakers who go against them. When Congress tried to include a rate cap in the stablecoin bill called the Genius Act, which Trump signed into law in July 2025, the banking lobby successfully got it removed from the final version. Banks have a track record of killing proposals like this. On the other hand, this is an issue where public opinion is overwhelmingly on the side of lower rates. Nobody except bank shareholders likes 25% credit card interest. If Republicans block this, Democrats will hammer them in campaign ads. If Democrats block this, Republicans will hammer them. So we're in a situation where both parties have political incentive to at least appear to support this, even if they're quietly working behind the scenes to water it down or kill it. What should you do as a consumer? First, understand that nothing is happening immediately. Trump called for this to be effective January 20th, but that's not a binding deadline. Legislation takes time, and there's no guarantee this passes at all. Second, if you're carrying credit card debt right now, don't wait for Washington to save you. The most effective thing you can do is pay down that balance as aggressively as possible. Every dollar you pay beyond the minimum goes directly to principal and saves you compounding interest. Third, if you have decent credit, shop around. There are balance transfer cards that offer 0% interest for 12 to 18 months. That's a much better deal than hoping for a rate cap that may never come. Fourth, watch this issue closely. If actual legislation gets introduced, if there are committee hearings, if there's real momentum, that's when you'll know this is serious. Until then, treat this as an interesting political development, but not a done deal. The banking industry has already fired the first shot in this battle. Their joint statement made clear they will fight this with everything they have. They'll argue it hurts consumers. They'll argue it reduces credit access. They'll fund studies showing negative economic impacts. They'll lobby every senator and representative they can reach. But here's the thing. Public anger at the banking industry is real. The 2008 financial crisis, where banks got bailed out with taxpayer money while ordinary Americans lost their homes, is still fresh in people's minds. The fact that Jamie Dimon can make $770 million while families struggle to pay 25% interest on necessary expenses creates a political opening for change. Whether Trump is serious about this, whether he'll actually push Congress to pass it, whether he'll use the power of his office to make it happen, those are open questions. His track record so far has been more friendly to banks than to borrowers. But the fact that he's even raising this issue puts pressure on the system. And pressure creates cracks. Cracks create opportunities. And opportunities create change. This is a story worth following, because if it actually happens, if Congress passes a 10% rate cap, it would be one of the most significant consumer protection victories in decades. $100 billion per year staying in American households instead of going to bank profits. Thousands of dollars per family. But if it dies in committee, if it gets watered down to meaninglessness, if Trump moves on to the next issue and forgets about this, then it was all just political theater. Empty promises designed to win votes without delivering results. The next few months will tell us which version we're looking at. So stay informed. Watch for actual legislation. Watch for committee hearings. Watch for whether Trump uses his platform to push this, or whether he lets it quietly fade away. Watch for whether your representatives support it or side with the banks. Because this isn't just about interest rates. It's about whether the political system can deliver tangible economic relief to ordinary people, or whether the banks are simply too powerful to challenge. The battle lines have been drawn, big banks on one side, millions of debt-burdened Americans on the other, and Washington in the middle, trying to figure out which side wins. If you found this analysis helpful, subscribe to stay updated on how this develops. Because whether this becomes real policy or fades into political noise, it's a story that affects millions of Americans directly. The announcement has been made. The banks have responded. Now we wait to see if words become action.